better. Nice. Hmm. Let's test and see how this works. Hmm. Hmm. Interesting. Ooh. Oh. Ooh. Mm. Mm. Hmm. Oh, hello everybody. I'm sorry. Hi, how are y'all doing? I'm sorry, I'm touching stuff because this is my first time going live on YouTube. So I just was playing with stuff. Sorry. How y'all doing? Y'all good? Oh, no, no. Hi, I'm Latasha McDowell, for those who don't know. You're a real estate expert here in Tallahassee, Florida. So, what do you all have going on today? I myself am a little worried and a little stressed because I have a niece who did not evacuate in New Orleans, so I'm going to use you guys as a little distraction. So let's talk about loan for home ownership and different loan types. So there are typically the FHA loan, conventional loan, and there's the USDA loan, VA loan, and there's also the jumbo loans, which is an option if you're trying to purchase a multi-million-dollar home or a large property. You can also get a jumbo loan, and there's also the NACA loan, which is zero down payment, zero closing costs. So you do have a lot of variety options. Now, here's something I mentioned the other day that I'm not quite sure a lot of people talk about quite often, which is called a bridge loan. And this is mostly used for people who already own property or already have a home, and they're wanting to purchase new property or additional property. And they can take a bridge loan, and it's kind of bridging the gap in between the two loan types. So with the bridge loan, what you can do is you can go ahead and take that loan out from your equity and use it as a down payment towards a new home. So that's what a bridge loan is. Um, and a lot of people don't talk about it very often. Not quite sure why. It's very helpful to people who already own property and want to purchase an additional property and may not have the funds for the down payment, because typically when you're purchasing a second property, you're required to put down 20%, right? So where's that money going to come from? Well, you can use the equity in the current home that you have to purchase or use it as a down payment. Some people can use it, you can use it for 2 weeks, or you can use it for up to a year. But it's a bridge loan, and it kind of bridged the gap for you. That's why it's bridge. Now, as far as an FHA loan, conventional loan, USDA loan, those loan types are most frequently used when purchasing residential property. The USDA loan is a zero down payment product, that's based upon the location that you're in. So if you're purchasing a home within a certain location, typically they say rural, but rural nowadays really isn't rural. For example, where I live, it's outside the city limits. So since it's outside the city limits, you can qualify for a USDA loan, right? So that's a zero down payment, which is a major cost savings. Then there's also the FHA loan, which has a 3.5% down payment. What, husband? Which has a 3.5% down payment. With the 3.5% down payment, sorry y'all, with a 3.5% down payment, if you have a credit score of minimum of 500, you can qualify for a FHA loan. Now, can you find a lender who's going to lend you money with a 500 credit score? I haven't found one yet. The least or the smallest score I've seen the person get approved for is about 615, 617. And that was for an FHA loan, but that person had a very low debt to income ratio. Now, typically, when you're dealing with the FHA loan, most people like that because of the low down payment. But if your credit score is in between the 500 and 579, then your down payment is going to be 10% versus the 3.5%. Okay? And in case you're wondering what company was able to approve my client with a credit score at about 615, it was Loan Depot, which is one of my preferred lenders. I like them a lot. And I like the service level and how user friendly they are. Even if you're not quite at the point of home ownership, I like the fact that they give you a path. They're very good about that. Synovus Bank is very good about that as well. Those are my top two go to and Great Rate. So Great Rate, Synovus, and Loan Depot. Those are my top three that lenders who I typically deal with because I know that they're going to take care of my clients. So now if your credit score is above the 620, in between 620 and 640, you are in a better position. But you still need to make sure your debt to income ratio is at least 30% or below. Max 40. Don't go beyond 40 because it's the more higher your debt to income ratio is, the less buying power you're going to have. Okay? Because when you're looking at your debt to income, it's your amount of income that you have coming in versus how much debt you're paying each month. Now, when they're doing that calculation for your debt to income ratio, it is not including things such as your rent, utilities, car insurance, um, things of that nature. It's looking at all the items that's on your credit bureau report. So your debt to income ratio does make a difference when you're purchasing a home. Another major thing that I've been talking about lately that quite a lot of people are not quite understanding really how it works is your rent. As of September 15th, Freddie Mac, which is a government agency that purchases home loans from lenders, will now be helping clients or helping people get approved by using their good payment history of their rent to help them get approved for a home. So your rent can help you really on the front end, on the back end. On the front end, if you add your rent to your credit bureau report, it will help you boost your score because you've been making that payment on time for over a long period of time. And on the back end, once Freddie Mac sees that you have been making these payments on time, because they're going to ask you for permission, but once they see that you've been paying your rent on time each month, they're in turn going to tell your mortgage company or the lender whom you've applied with that it's a good loan. And so therefore they'll approve you because they want their loan to be purchased from them by Freddie Mac. Now let's talk about a conventional loan. With a conventional loan, there's two different types, okay? You can either have a 3% down payment or you can have a 5% down payment with a conventional loan. Typically with a conventional loan, usually your credit score has to be higher and your debt to income ratio has to be lower. With a conventional loan, most sellers, when you're in a competition for purchasing a home, they like a conventional loan more because the home does not have to meet all of this different criteria as a FHA home will require. A FHA home is going to have more restrictive requirements the home has to meet as far as the inspection is concerned and the age of the home and things of that nature, versus conventional is a lot more lax. So the sellers will prefer to purchase or to pick a conventional person, a person has a conventional loan versus a person who has an FHA loan, because they know with an FHA loan, their house has to meet a higher standard, right? Which may cause some hiccups and also may cause them financial woes if they have to go ahead and start paying for repairs. So of course they don't want to deal with that. So of course they're going to pick the conventional loan, what does not have in order for the person to get approved to purchase their home. So that's why they typically will go with conventional over FHA. So VA loans is for veterans who have a general or honorable discharge, and that's a zero down payment. If you're a vet, I have a link in my bio where you can get your certification so you can go ahead and use that to purchase your home. Also, the next loan type is a NACA loan. right? NACA, NACA, and their website is naca.com. It's a loan with zero down payment, zero closing costs. That's not based upon credit, but it is based upon character. And here's what they mean. You basically have to have not had any late payments within the last 24 months. If in the event that you do have late payments, this is where you would come into using the credit skills that I've taught you to get these things removed. But with them, you have zero down payment, zero closing costs, no fees. Your interest rate is low, about 3%, and you can also buy it down all the way to 1.5%. And it's like walking around with a check. Like, you may think that when you're pre-approved by FHA lender or with your conventional lender, the difference with a NACA loan is that you've already gone through underwriting. Before you've gotten approved, it's already gone through underwriting. Every T has been crossed, every I has been dotted. Go out, pretty much you're slapping on a check when you are out there putting out an offer. With the FHA or conventional loan, if you have a pre-approval, you still have to go through the underwriting process where they have to go back and check all your financial records. They have to go back, and even though you might have done it with pre-approval, they do a much more invasive look when it comes down to getting your home when it's a conventional FHA loan. They're going to do a much more forensic financial look to make sure everything is done. And that comes after you put in the offer, whereas with the NACA, it's done before. So that's loans. And with that, this was my first live on YouTube. So I'll try and do it again with a different topic. But thank you guys for listening. As always, I'm Latasha McDowell, your real estate coach here in Tallahassee, Florida. Toodles.